Welcome to the Deep Dive. Today we're cutting through the noise around a truly eye-popping day on Wall Street, Wednesday, August 13th, 2025. This wasn't just another trading session. It was a day when the S&P 500 and NASDAQ Composite weren't merely climbing, they were hitting new all-time highs for the second consecutive day.
Second day in a row, yeah. That's significant.
And the Dow Jones Industrial Average, it absolutely soared, pushing right to the brink of its own record, painting a picture of widespread optimism that felt almost palpable across the trading floor.
It's true, the market was riding a powerful wave. What's truly insightful here is that this wasn't, a minor tremor or a one-off rally.
No, not at all.
This was a sustained, powerful surge, hinting at a significant, almost euphoric shift in investor sentiment that had been building for some time. It makes you wonder what precise combination of factors could unleash such widespread confidence.
That's precisely what we're going to uncover. Our mission today is to take a deep dive into the very forces that powered this remarkable market rally. What drove such a strong performance? And perhaps even more importantly, what surprising, possibly even contradictory dynamics were at play just beneath the surface. We've pulled together insights from a comprehensive daily market review, and we're going to extract the most potent nuggets of knowledge, the aha moments, specifically tailored for you.
Our goal is to truly unpack this complex financial snapshot. We'll pinpoint the dominant narratives that everyone was talking about, but then we'll peel back the layers to explore the hidden nuances and highlight those critical signals that investors, that you, need to be acutely aware of.
Exactly.
We'll zoom out for the big picture, then drill down into specific sectors and individual companies, and even expand our view to the global geopolitical landscape that's subtly, or maybe not so subtly, influencing everything.
So let's begin by setting the stage. What did the final numbers on August 13th tell us about the sheer breadth and enthusiasm of this market session?
The closing figures really do tell a story of undeniable bullish sentiment taking hold. The S&P 500, a key barometer for the broader market, closed at 6,466.58. That was a solid gain of 0.32%. Not to be outdone, the NASDAQ Composite, home to so many growth and technology giants, finished at 21,713.14, up 0.14%.
Both hitting records again.
Both of these critical indices, for the second straight day, notched new all-time highs. Like you said, this isn't a fluke. It's a powerful continuation of the momentum we saw building on Tuesday.
Right.
And the Dow Jones Industrial Average. It truly showcased robust participation across traditional industries, jumping by over 460 points, specifically 463.66 points, or a healthy 1.04%, bringing it tantalizingly close to its first record high since, December 2024.
Yeah, it's been a while for the Dow.
It has. This kind of widespread advance across all major benchmarks really signals a deep-seated confidence that pervaded the market.
It certainly does. When you see such broad and significant gains, it begs the question, what kind of market conditions, or more accurately, what specific catalyst would lead to such widespread optimism? It almost feels like the market has found its footing and is sprinting ahead after a period of uncertainty.
And if we connect this to the bigger picture, the conditions were heavily influenced, almost entirely driven, actually, by one specific piece of economic data that had just been released.
Which brings us to the undeniable engine of this rally. The market's overwhelmingly enthusiastic reaction to the July Consumer Price Index, or CPI, report.
That's the one.
While this crucial inflation data was actually released on Tuesday, the market's digestion and interpretation of it on Wednesday truly solidified investor conviction. It felt like the entire financial world collectively breathed a sigh of relief.
That's an excellent way to put it. This data was interpreted as a definitive green light for the Federal Reserve. It cemented investor belief that the Fed is poised to initiate an interest rate cutting cycle, possibly as early as September.
As early as next month.
Yeah. Looking at the detailed data from the U.S. Bureau of Labor Statistics, the headline CPI for July rose just 0.2% month over month and 2.7% year over year.
Okay, those sound pretty tame.
These figures were generally in line with or even slightly below economists' consensus estimates. The market, in its eagerness, immediately seized upon these readings as undeniable evidence that inflationary pressures are now sufficiently contained.
But here's where it gets really interesting and perhaps a bit nuanced. There's the headline CPI number, which sounds great, but then there's core CPI. And it seems the market selectively focused on one over the other. What's the story there?
You've hit on a crucial distinction, and this is important for you, the listener, to understand. The core CPI, which meticulously strips out the more volatile food and energy prices to give us a clearer picture of underlying inflation.
Right, the Fed watches that closely.
Actually rose 0.3% for the month and a stickier 3.1% over the last 12 months. Now, 3.1% is still comfortably above the Fed's long-term 2% target. However, the market, in its powerful rush of optimism, appeared to look past this stickier figure. Instead, investors chose to amplify the positive signals, focusing intently on the headline trend and other recent signs of economic softening, such as the slightly weaker jobs data we've seen.
So confirmation bias, maybe. Finding the narrative they wanted.
It's a classic example of the market finding the narrative it wants to believe, filtering data through a lens of strong conviction for an impending Fed pivot.
And this interpretation, this almost collective filtering, had immediate and dramatic impacts on expectations for future rate cuts, didn't it?
It absolutely did. The CME FedWatch tool, which is a crucial barometer for market sentiment on future Fed actions, indicated a staggering 98% probability of a 25 basis point rate cut at the September FOMC meeting.
98%. That's basically baked in.
For clarity, a basis point is 1/100th of a percentage point. So 25 basis points is 1/4 of a percentage point. This near certainty of a cut reflects profound conviction. Furthermore, futures markets are now pricing in a more than 50% chance of 3 total white cuts by the end of 2025.
3 cuts by the end of 25. That's quite a shift.
It is. And adding to this fervor, we even saw U.S. Treasury Secretary Scott Bessent publicly urge the Fed on Wednesday to consider an even more aggressive 50 basis point cut in September.
A 50-point cut. That would be something.
Yeah, this kind of public commentary from a high-profile official truly adds significant fuel to the fire, reinforcing the prevailing market narrative.
And the bond market, often regarded as the more sober, grounded part of the financial world, seemed to corroborate this narrative perfectly. What did we see there?
Precisely. The bond market offered clear, undeniable evidence. The yield on the benchmark 10-year Treasury note, a key indicator of long-term borrowing costs and economic expectations, fell significantly.
How low did it go?
It moved into the 4.23%, 4.25% range, which is a notable decline from its mid-July level of 4.50%.
That's a big move for Treasuries.
It is. This sharp drop in yields provides compelling evidence of conviction among fixed-income investors that lower interest rates are definitely on the horizon. For equities, lower interest rates reduce the discount rate for future corporate earnings, essentially, the rate at which future profits are valued today.
Right, making future earnings look better now.
When that rate is lower, future profits are worth more now, making stocks inherently more attractive. It's a powerful signal from the fixed income side, signaling their agreement with the equity market's enthusiasm.
So what does this all mean for you, whether you're managing a business or just planning your personal finances? The practical takeaway here is what?
Well, it signifies cheaper borrowing costs for businesses, which can fuel investment, expansion, and hiring.
Okay, good for the economy.
And potentially it means cheaper borrowing for you personally, for things like mortgages, car loans, or other forms of credit down the line. That can stimulate consumer spending and overall economic activity. It's a powerful tailwind for the economy that directly impacts your wallet.
Beyond just the headline numbers and the CPI data, let's talk about the underlying health of this rally. How are the market internals looking? Was this just a handful of mega-cap stocks driving everything, or was the optimism truly widespread?
The market's internal dynamics absolutely reflected overwhelming optimism, signaling a broad-based, genuine risk-on environment. First, let's look at volatility, which is a measure of market fear or complacency.
The VIX.
Yeah, the SIBO Volatility Index, or VIX, often affectionately called Wall Street's fear gauge, sank to its lowest level of the year, closing around 14.39.
Lowest of the year, wow.
This plunge in expected volatility suggests that investors anticipate remarkably smoother sailing ahead, a clear reduction in perceived risk. Similarly, the MOVE Index, which measures implied volatility in the Treasury market, it's like the VIX for bonds.
Okay.
Its plunge to its lowest level since January 2022 indicates a dramatic calming of nerves in the bond market as well, reinforcing the view that rate cuts are a near certainty and the path forward is clear.
That's interesting. While low volatility usually sounds good, isn't there a potential flip side to that? A warning, perhaps?
This raises an important question. While current confidence is certainly high, such extremely low levels of volatility can also be a contrarian indicator, suggesting investor complacency.
meaning people are maybe getting too comfortable.
It implies the market may be underpricing potential risks, especially when you consider some of the significant geopolitical landscapes we'll touch on later. It's a calm that could prove to be quite fragile, a moment where the market is perhaps a bit too comfortable.
Okay, let's unpack this. It's like seeing not just the star players scoring all the points, but the entire team performing exceptionally well. That suggests a more sustainable kind of growth. How did the market breadth look that day?
The rally's health was robustly confirmed by what we call strong market breadth. Market breadth measures how widely distributed the gains are across the entire market, not just concentrated in a few big names.
Right, you want broad participation.
Exactly. On the New York Stock Exchange, for every stock that declined, a very strong 4.26 issues advanced. So advancing issues outnumbered decliners by over 4 to 1.
4 to 1, that's pretty decisive.
It is. And on the NASDAQ, the ratio was also a healthy 2.69 to 1 in favor of advancers. This is a critical point. It indicates that the gains were not concentrated in a handful of mega-cap stocks, which can sometimes signal a precarious or unsustainable rally.
Which we've seen before.
We have. Instead, the gains were broadly distributed across a vast majority of stocks, which is the hallmark of a much healthier and more participatory advance. Regarding trading volume, it was noted as 16.4 billion shares, slightly below the 20-session average of 18.3 billion.
So slightly lower volume, but not alarmingly so.
Yeah, while a minor consideration, it certainly doesn't detract from the overall strength and conviction behind the day's move.
So with that clear picture of the overall market sentiment, the next logical question is, where exactly did investors decide to put their money? Let's zoom in from the broad market to the specific sectors and themes that truly caught fire.
What's truly striking here is that it wasn't just a rising tide lifting all boats equally. Some boats definitely got a much bigger push.
Right.
The optimism was indeed broad-based, with all 11 broad sectors of the S&P 500 finishing the session in positive territory. However, leadership clearly came from the more growth-oriented and economically sensitive corners of the market, meaning investors were placing bets on areas that thrive when the economy is perceived as stable or improving, especially with the promise of lower rates.
So where did we see that leadership manifest most prominently?
The communication services sector, tracked by the XLC ETF, was a standout performer, climbing 1.9%.
Okay.
Right behind it was technology, represented by the XLK, which rose 1.6%. These sectors have consistently led the market for much of the year, driven by relentless innovation and compelling growth prospects, and investors clearly flocked to them on optimism about interest rates.
The usual suspects leading the charge then. But it wasn't just tech and communications, was it? Other cyclical areas of the market also showed strong performance, suggesting a broader confidence in the economy.
Absolutely. We also saw robust gains in what we call cyclical areas, sectors like materials, XLB, which climbed 1.3%, financials, XLF, gaining 1.2%, consumer discretionary, XLY, adding 1.1%, and industrials, XLI, up 1.0%.
So pretty broad strength across those economically sensitive areas.
Yes. The strength in these sectors, which are highly sensitive to the overall health and growth of the economy, reflects a clear belief among investors that softer monetary policy from the Fed will provide strong support for overall economic activity and corporate profits.
And critically.
Critically, this is happening without tipping the economy into a recession. It's what many are calling a Goldilocks scenario, just right, with cooling inflation, a resilient economy, and the promise of lower borrowing costs. This is the sweet spot the market has been craving.
Okay, let's dig a bit deeper. Beyond just broad sector movements, what specific investment themes or narratives truly captured investor attention and capital?
Beyond the broad sector movements, several distinct investment themes attracted significant capital, revealing a more granular look at where sophisticated investors were placing their bets and what stories they were buying into.
So let's start with the most obvious beneficiaries of the rate cut narrative. The interest rate sensitive industries.
Indeed. Home builders were absolutely clear beneficiaries. Shares of Pulte Group, for instance, climbed a healthy 5.4%, and Lennar rose 5.2%.
Makes perfect sense. Lower rates, good for housing.
This was all on the very strong prospect of cheaper mortgage rates, which would undoubtedly spur housing demand. It's a direct, intuitive link between monetary policy and sector performance.
Right.
Airlines also saw a significant boost. Major carriers like United, Delta, and American rose impressively between 8% and 11% on Tuesday and largely held those gains on Wednesday.
Big moves for airlines. Why the double boost there?
Their ascent was doubly fueled. First, by the broader hope of increased consumer spending power due to an improved economic outlook, and second, by a fascinating specific detail from the July CPI report itself, which showed that airfares had actually risen for the first time in 5 months.
Ah, so pricing power returning maybe.
Potentially. This particular data point, combined with the macro optimism, created a powerful tailwind. This optimism extended across the entire consumer discretionary space, with big box retailers, resorts, and casinos also posting solid gains, signaling confidence in the consumer's willingness to spend.
Now that AI space has been a seismic story all year, was it still just a blank check for any company touching AI? Or were investors showing more discernment in how they deployed capital in this red-hot sector?
That's a critical question, and what's particularly illuminating here is that the market's reaction to AI news was notably nuanced, signaling a maturing in how investors view the sector.
Okay, so not just buying anything with AI in the name anymore.
Right. While AI clearly remains a powerful driver, investors are now differentiating between companies based on execution and profitability, not just hype. For example, Lumentum Holdings, iTite, an optical and photonic products provider, saw its shares climb 4% after it both beat earnings estimates and cited strong demand from its AI data center solutions business.
So, delivering results mattered.
Exactly. This positive reception stands in sharp contrast to the punishment of AI cloud provider CoreWeave, which we'll detail a bit later, and which plunged despite massive revenue growth.
Ooh, okay. Foreshadowing there.
Yeah, this divergence clearly shows that the market is moving past the initial blanket excitement to scrutinize individual company execution, profitability, and the long-term viability of business models beyond just the AI label itself. It's no longer enough to simply be an AI. You have to prove you can make money from it.
And then we had the crypto renaissance bubbling up again. It feels like we've heard this story before, but this time there was a truly spectacular case study that caught everyone's eye.
The speculative enthusiasm for crypto-related equities was undeniable, reignited by near all-time high prices for major digital assets. Bitcoin hovered near $121,600, and Ether traded above $4,700, both having posted substantial gains in 2025.
Big numbers there.
This backdrop set the stage for an astonishing surge in a rather unexpected name, 180 Life Sciences, ATNF.
TNF. What happened there?
This biotechnology company's shares soared by as much as 70% after it announced a bold plan to rebrand as ETHZilla and, perhaps more remarkably, adopt an Ether treasury strategy, revealing it already held nearly $350 million in Ether. That's a pivot.
A major pivot. What's truly compelling here is that this move, notably backed by billionaire Peter Thiel, consciously echoes the incredibly successful Bitcoin treasury strategy pioneered by MicroStrategy, MSTR.
The MicroStrategy playbook.
Exactly. It clearly signals a new, perhaps more aggressive avenue for public companies to gain direct crypto exposure and for investors to gain speculative exposure through traditional equities, bypassing the complexities of direct crypto ownership. That's a bold and unconventional move, and the market clearly rewarded it. But crypto wasn't the only renaissance we saw gaining momentum. The nuclear energy sector also caught fire, driven by a powerful policy narrative.
This is indeed a powerful, policy-driven theme that continued to gain significant momentum in the energy sector. Analysts at Morgan Stanley, for example, declared that the world is experiencing a profound nuclear renaissance, upgrading their forecast for investment in the sector from $1.5 trillion to a staggering $2.2 trillion through 2050.
$2.2 trillion. It's a huge number.
It is. This bullish outlook is underpinned by two major catalysts. First, U.S. President Donald Trump has made energy security a central policy theme for his administration, setting an ambitious goal to grow America's nuclear energy capacity from about 100 gigawatts today to 400 gigawatts by 2050.
Quadrupling capacity.
Yeah, and he's already signed executive orders aimed at expediting plant construction, signaling strong government backing. Second, and equally important, the World Bank recently lifted its long-standing ban on financing nuclear power projects.
That is significant for global funding.
Hugely significant, as it could pave the way for other international lenders to follow suit, potentially unlocking substantial capital for nuclear projects globally. This confluence of strong policy support and institutional validation has made nuclear-exposed stocks like Talon Energy, TLN, and Vistra, VST, strong outperformers, reflecting belief in a powerful long-term shift towards this energy source.
So when we pull back from the broad numbers, what does this all mean? It shows investors aren't just blindly buying into the broad rally. They're looking for specific narratives, clear policy tailwinds, and strong fundamental stories, even within the larger market trend. It's a very selective optimism.
That's a great way to put it. Selective optimism.
We talked about broad market movements and sector trends, but now let's shift focus to individual company stories. This is where the market truly showed its discerning eye, rewarding strategic clarity and punishing weakness, even amidst widespread optimism. It proves that even in a rising tide, not all boats float equally well.
You're absolutely right. Despite the rising tide lifting all major indices, the market was highly discerning, acting as a strict grader of corporate performance. The day's most dramatic stock movements were driven by company-specific news, primarily second-quarter earnings reports and major strategic announcements.
So fundamentals still matter, even in a rally.
This illustrates a key dynamic. Investors are rewarding strategic clarity, operational excellence, and a clear path to profitable growth, while harshly punishing any signs of weakness, slowing momentum, or crucially, growth funded by excessive cash burn. The market might be bullish, but it's not forgiving.
Let's start with the surprising successes, the top gainers of the day. Who delivered positive surprises, and what did the market react to so strongly?
The top performers were largely companies that delivered stronger than expected earnings, or even more powerfully, announced truly transformative strategic news. The most spectacular gainer of the day, an absolute outlier, was Webtoon Entertainment, WBTN.
Webtoon. Tell me about that one.
Its shares skyrocketed by as much as 93% during the session before closing with an astounding 86.1% gain.
86%. Okay, what happened there?
Well, the digital comics platform did deliver a solid second-quarter earnings report, beating analyst expectations on both the top and bottom lines, with adjusted EPS of 0.007 cents against a 0.02 consensus and revenue of $348.3 million, surpassing forecasts.
So good numbers, but maybe not that good.
Right. These numbers alone weren't the primary driver of such a monumental stock move.
So what was the true catalyst for that kind of explosion? You don't see 86% jumps every day.
The true game-changing catalyst was the unexpected announcement of a multi-year strategic partnership with none other than the Walt Disney Company, Dis.
Disney, wow, okay.
This deal will bring approximately 100 comic titles from Disney's vast, beloved library directly onto the Webtoon platform. This is a profound qualitative event that investors recognize as fundamentally altering Webtoon's strategic position and growth trajectory.
So massive content injection.
Massive. The partnership provides a huge injection of high-quality, globally recognized intellectual property. Think Marvel, Star Wars, Pixar characters, now available as digital comics on Webtoon.
That's huge for user acquisition and monetization.
Exactly. This can attract millions of new users, enhance monetization opportunities through subscriptions and advertising, and solidify Webtoon's leadership in the digital comic space. The market's explosive reaction indicates a strong belief that the synergistic deal will accelerate revenue growth significantly, making the earnings beat, while supportive, almost a secondary factor. It's a masterclass in strategic storytelling paying off in a huge way.
That's a perfect example of how a smart strategic move and good story can pay off big time, sometimes dwarfing the impact of quarterly numbers alone. Were there any other notable gainers that illustrate this pattern?
Absolutely. Sapiens International, SPNS, a software provider for the insurance industry, climbed over 44% on strong earnings and positive sentiment for the tech sector, reflecting robust demand for digital transformation. New Pluto Global, PSKY, surged over 37%, catching significant meme stock interest with high trading volume in the newly merged entity. Sometimes speculation just takes hold.
The meme factor.
Newegg Commerce, TAG, the online electronics retailer, gained over 24% amidst broad risk-on sentiment for e-commerce, benefiting from consumer optimism. And the Cheemers Company, CC, a materials sector player, saw its stock rise over 17% amid the broader economic optimism we discussed earlier. These all reflect a willingness to reward positive news and strong positioning, but Webtoon's leap was in a league of its own.
Now let's look at the other side of the coin, the companies that faced a harsh market reaction despite the overall bullish sentiment. What happened there, and what lessons can we draw about the market's current discernment?
In stark contrast to the day's winners, several companies saw their stocks plummet after failing to meet lofty investor expectations. This clearly illustrates that operational missteps, slowing momentum, or unfavorable guidance will simply not be tolerated, even in a bull market.
The market has standards, even when it's happy.
Exactly. The market is discerning, even punitive, when it comes to fundamentals and the path to profitability.
Let's start with CoreWeave, an AI-focused cloud provider. This one is particularly ironic, given the immense hype and investment we've seen in the AI space this year. What happened?
It truly is ironic, and it highlights the market's evolving understanding of growth at any cost. CoreWeave, CRWV, saw its shares plunge by approximately 19–20%.
Down almost 20%, but I thought AI was invincible.
Well, the head-scratching part for many was that this happened despite the company reporting staggering second-quarter revenue of $1.21 billion, which was a year-over-year increase of over 200% and actually beat analyst estimates.
Beat estimates and still dropped 20%. What gives?
On the surface, it looked like a runaway success. The market, however, looked straight past that impressive top-line growth and focused ruthlessly on the bottom line. A net loss of $290.5 million, or $0.60 per share, which was significantly wider than the forecast loss of $0.45 per share.
Ah, the bottom line. So what caused that huge loss? And why did the market punish them so severely when they were clearly growing so fast in a hot sector?
The ballooning loss was attributed to a massive 276% jump in operating expenses, reaching $1.19 billion, and equally massive capital expenditures of $2.9 billion, as the company races to build out its infrastructure to meet the exploding demand for AI compute power.
So spending huge amounts to grow.
Exactly. While CoreWeave did raise its full-year revenue guidance, it also signaled plans for an additional $20 to $23 billion in future investments to expand its data centers.
20 to 23 billion more.
Yeah. This raised serious, almost existential concerns among investors about its path to profitability and its immense cash burn. In essence, the market's verdict was clear. Brute force growth funded by deep, accelerating losses is no longer an acceptable strategy, even in the white-hot AI sector.
So the grow-at-all-costs model is officially out.
It seems so, at least for now. Investors are now looking for a clear path to sustainable, profitable growth, not just growth at any cost. It's a significant maturation of how the market is valuing AI companies.
That's a very harsh reality check. Another big loser was Carrier Group, the fast-casual Mediterranean restaurant chain. This one seems to contradict the broad consumer discretionary optimism we discussed earlier. What went wrong there?
It absolutely does, and it provides a critical micro-level data point that flew directly in the face of the macro optimism. Carrier Group, saw its stock tumble by about 16%.
16% for Savier. Why? Did they miss earnings badly?
The irony, again, much like CoreWeave, is that Carrier did beat bottom-line expectations, reporting adjusted earnings of $4.16 per share versus a forecast of $13.13.
Beat on the bottom line, too. So what was the problem?
Investors honed in on two critical signs of weakness. First, revenue of approximately $280 million missed forecasts. Second, and much more importantly, same-restaurant sales, a key metric for retail and restaurant chains, grew by just 2.1%.
Only 2.1% same-store sales. That sounds weak.
It was a dramatic slowdown and a huge miss compared to the 6.25% growth analysts had anticipated. It signals weakening demand at the individual restaurant level.
And their commentaries seem to make things even worse, offering a stark warning about consumer health.
Precisely. The company compounded the bad news by cutting its full-year guidance for this key metric. Critically, the CEO stated that consumers are navigating a fog of economic uncertainty.
A fog of economic uncertainty. That doesn't sound bullish.
No, it doesn't. This was a stark, almost chilling warning about consumer health that directly contradicted the broad rally in consumer discretionary stocks we saw that day. It suggests that while the market is hopeful for a strong consumer driven by rate cuts, there are still very real-world pressures being felt at the ground level, especially among everyday consumers facing lingering inflation or other uncertainties. It's a reminder that macro trends don't always translate perfectly to every business.
So what does this all mean for you, the individual investor? It's a clear message. Even in a bull market, investors are scrutinizing fundamentals very closely. Growth is certainly great, but profitability and sustainable business models are king. It's not just about what you can do, but how efficiently and profitably you can do it.
Indeed. Other notable losers included Centrus Energy Corp, LEU, down over 13% due to profit-taking after a strong run-up in the nuclear sector, indicating that some gains are being realized.
Taking some profits off the table there.
Maple Bear, Cart, the parent company of Instacart, fell over 12% due to negative reaction to earnings and competitive pressures in the delivery space, showing how quickly sentiment can shift in a crowded market.
Tough business. Delivery.
And USA Rare Earth, USR, was down over 10% on broader concerns about commodity pricing in global industrial demand. These all underscore the market's discerning eye.
Let's broaden our view now to the international stage and the geopolitical landscape. Was the U.S. rally happening in isolation, or did the rest of the world join the party? And perhaps most critically, what significant, surprising geopolitical tensions are the markets potentially overlooking right now, given this widespread optimism?
What's truly fascinating here is that the U.S. rally didn't happen in isolation at all. It was both a driver of and a participant in a truly global risk-on wave.
Okay, so the optimism spread.
Oh, yes. Equity markets across Asia and Europe surged as most had their first opportunity to fully react to the U.S. CPI data from the previous day and the subsequent Wall Street rally. It's abundantly clear that the ripple effect of U.S. economic news is global, with markets worldwide eagerly joining the party.
So how did Asia respond to this wave of optimism? Were there any standout performances in that region?
In Asia, the sentiment was overwhelmingly bullish, almost universally positive. Japan's Nikkei 225 index climbed 1.3%, hitting a remarkable new record high and crossing the 43,000 mark for the first time ever, a truly historic moment for Japanese equities.
Nikkei at a record high, crossing 43,000. That's big news.
Huge. Hong Kong's Hang Seng Index was another standout performer, leaping an impressive 2.6% higher, reflecting a strong rebound.
Hong Kong joining in strongly.
Elsewhere in the region, South Korea's Kospi advanced a solid 1.1%, Singapore's Straits Times gained 1.2%, and even China's Shanghai Composite rose a more modest but still positive 0.5%.
So broad strengths across Asia.
Yes, this broad regional strength unequivocally underscores the extent to which global markets are taking their cues from U.S. economic data and its profound implications for the world's most influential central bank, the Federal Reserve.
And Europe also joined the rally, following suit.
Yes, absolutely. European markets extended their gains from the previous session, also buoyed by the prospect of U.S. rate cuts and the broader global optimism. Germany's DAX index rose 0.7%, France's CAC 40 added 0.5%, and the Pan-European Stocks 600, a broad measure of European equities, climbed 0.5%.
Right.
In London, the FTSE 100 posted a smaller gain of 0.3%, but still in positive territory. It truly was a synchronized global advance, all echoing the sentiment of lower rates and a calmer inflationary outlook.
Now here's where the plot thickens, and perhaps where the biggest potential disconnect lies. Equities are suggesting a de-risking environment, a smooth ride ahead. Yet the geopolitical landscape is anything but calm. What high-stakes events are potentially being overlooked or perhaps even underpriced by the market right now?
This raises a profoundly important question, and it's something investors need to keep a close eye on. While equity prices suggest a relatively benign and de-risking environment, the geopolitical landscape is indeed fraught with high-stakes events that could easily disrupt the current market. The upcoming summit between U.S. President Donald Trump and Russian President Vladimir Putin, scheduled for Friday, August 15th in Anchorage, Alaska.
Right, the Alaska Summit. The stated goal of this summit being to negotiate an end to the brutal three-year war in Ukraine. This is clearly a massive undertaking.
Exactly. The market, in its current optimistic mood, appears to be pricing in a degree of hope for a potential ceasefire, which would undoubtedly be a significant tailwind for global risk assets, removing a major source of uncertainty.
So markets are hoping for peace.
It seems that way to some extent. However, this summit is laden with immense risk and binary outcomes. Reports suggest that Russia may demand major territorial concessions in eastern Ukraine as a condition for peace, which is a non-starter for Kiev, who views it as a violation of their sovereignty.
Huge sticking point.
Absolutely. And critically, Ukrainian President Volodymyr Zelensky is notably not scheduled to be part of the direct talks. This raises significant fears in Europe and Kiev that a deal could be struck at Ukraine's expense.
Understandable concern.
A failure of the summit to produce a breakthrough, or worse, a deal perceived as detrimental to Ukraine without its direct input, could rapidly reintroduce significant geopolitical risk and volatility into the market. Investors are leaning optimistic, but the path is extremely narrow.
But while the market is intensely focused on the Alaska Summit, there's another major escalating conflict that it seems to be almost completely ignoring. And this one, unlike the abstract fear of war, sounds like it could directly threaten the very disinflationary narrative that's currently driving this entire rally.
This, to me, is perhaps the single major underpriced headwind right now, the rapidly intensifying trade war between the United States and India.
U.S. and India, that sounds serious.
This isn't a small skirmish. It involves the world's two largest democracies, and the market's collective blind spot here is, quite frankly, astonishing. The Trump administration has dramatically intensified a trade dispute with India, imposing a punitive 25% tariff on Indian goods, and then just recently adding another 25% penalty, bringing the total tariff to a crippling 50%.
50%. That's not just significant, that's almost prohibitive. And what's the stated reason for this massive escalation against such a key global partner?
The administration has explicitly linked this aggressive action to India's continued large-scale purchases of discounted Russian crude oil. Washington claims these purchases are fueling the Russian war machine, thereby undermining Western sanctions against Moscow.
Ah, linking trade to the Ukraine war.
Precisely. This tariff war poses a direct and tangible threat to the very disinflationary narrative that is currently propelling the market rally. A 50% tariff isn't just a number. It means Indian textiles, apparel, shrimp, and chemicals suddenly become dramatically more expensive or even uncompetitive for American consumers and businesses.
Which means higher prices for us here.
This directly translates to higher prices in stores, forces companies to find new, potentially more expensive suppliers, and massively disrupts established supply chains. The exact recipe for renewed inflationary pressures, undoing the very progress the market is cheering about inflation.
So what's the expected impact of this escalating trade friction on both sides, specifically on their economies?
For India, these tariffs will severely impact key export sectors, potentially cutting its exports to the U.S. by 40–50%, a truly devastating hit to those industries. Analysts estimate this could reduce India's GDP growth by an estimated 0.3 to 0.6 percentage points, a noticeable drag on one of the world's fastest-growing economies.
A big hit to India's growth. And for the U.S.
For the U.S., this will inevitably raise the cost of imported goods, force domestic businesses to contend with disrupted supply chains, and could add to domestic inflationary pressures, the very thing the market is celebrating the absence of. The disconnect is profound. The market is rallying to record highs while seemingly ignoring this direct and escalating economic conflict between two major strategic partners. It truly highlights a significant blind spot between current market sentiment and tangible, escalating geopolitical and economic risk.
So when we put all this together, it means while everyone's celebrating the calm on the surface, there are some very real potent risks bubbling beneath that could change the whole picture very quickly. It's almost like the market is holding its breath on some of these issues.
Exactly. And it's not just geopolitics. We also saw interesting movements in commodity and currency markets, largely reinforcing the dominant rate cut narrative, but also hinting at broader economic forces at play.
How did oil prices react? They're usually a good indicator of global economic health and inflationary pressures.
Oil prices plunged, with West Texas Intermediate, or WTI, crude oil futures falling to a 2-month low, dropping below $63 per barrel.
Below $63. That's quite a drop. Why?
This significant drop was largely precipitated by a bearish monthly report from the International Energy Agency, or IEA. The IEA raised its forecast for global oil supply in 2025, while simultaneously lowering its demand forecast, leading it to conclude that oil market balances look ever more bloated.
So potential oversupply coming.
That's the suggestion. Falling oil prices are a significant disinflationary force, directly reducing energy costs for consumers and businesses, thereby providing further justification for the market's belief that the Federal Reserve has ample room to cut interest rates without reigniting inflation.
Another point for the rate cut camp, then. And the U.S. dollar, how did it fare amidst all this talk of impending rate cuts? It usually moves inversely to rate expectations, doesn't it?
Precisely. The U.S. dollar index, which measures the greenback's value against a basket of 6 major currencies, fell to its weakest level in more than 2 weeks.
Dollar down. Makes sense with rate cut expectations rising.
Yeah, this weakening of the dollar is a direct and anticipated consequence of the sharp rise in Fed rate cut expectations. As investors anticipate lower U.S. interest rates, the yield differential between U.S. Treasury bonds and bonds in other countries narrows. This makes the dollar less attractive for foreign investors seeking higher returns, leading to a natural depreciation.
And what does that mean for U.S. companies?
For U.S. multinational corporations, this weakening dollar can be a significant tailwind as it makes their products cheaper and more competitive abroad, and also increases the value of foreign earnings when they are converted back into dollars. So it's a positive for corporate profits, especially for those with significant international exposure.
This raises an important question.
Yeah.
Are these market movements signaling true deep-seated stability? Or is it a fragile calm, perhaps even a moment of complacency before a potential storm? It definitely feels like there's a lot of underlying tension just beneath this surface of optimism.
It does feel quite tense beneath the surface, yes.
Now let's look to the horizon. After a session largely driven by the continued reaction to Tuesday's CPI data, what fresh data and what critical earnings reports will truly test the durability of this remarkable rally? What should we and you be watching for next?
The market's focus now squarely shifts to a slate of fresh economic data and corporate earnings that will determine if the current rally can be sustained, or if this moment of euphoria will prove fleeting. The prevailing narrative of cooling inflation and an impending Fed pivot will face its next major challenge, while key earnings reports will provide further ground-level intelligence on the health of the U.S. economy and, critically, the consumer.
So what's the most significant economic event on the immediate docket that could either confirm or derail this optimism?
That would undoubtedly be the release of the July Producer Price Index, or PPI, report on Thursday, August 14th at 8:30 a.m. ET.
PPI, producer prices. Why is that one so important right now?
This report, which measures inflation at the wholesale level, the prices producers receive for their goods and services, is a key leading indicator for future consumer price inflation. It will be meticulously scrutinized by investors for any signs that price pressures are reaccelerating from the producer side before they have a chance to feed through to the consumer level. It's a canary in the coal mine for inflation.
And what are the consensus forecasts telling us about what to expect from this PPI report? Are we looking for more cooling or a potential rebound?
The consensus forecast among economists is for the headline PPI to have risen 0.2% month over month. If this holds true, it would be an acceleration from the flat reading we saw in June.
An acceleration.
On an annual basis, headline PPI is expected to increase to 2.5% from 2.3% in the prior month. Similarly, core PPI, which strips out volatile food and energy prices, is also forecast to rise 0.2% month over month, with its year-over-year figure expected to climb to 2.9% from 2.6%.
So the market is expecting a slight pickup in producer inflation.
Yes, broadly expecting a slight reacceleration, but still within what might be considered a manageable range.
This sounds like a really critical test for the market's current conviction, especially regarding the Fed's next move, doesn't it?
It absolutely does. This data release represents a crucial test for the market's prevailing narrative of disinflation and impending rate cuts. A hotter-than-expected PPI report, particularly if the core reading comes in strong or surprises to the upside, could directly challenge the conviction behind the near certainty of a September rate cut.
How so?
Such a result would suggest that inflationary pressures are more entrenched at the producer level than the recent CPI data implied, potentially forcing the Federal Reserve to maintain a more hawkish stance, or at least a less lovish one. That, in turn, would directly undermine the very foundation of the current rally, which is built on the expectation of looser monetary policy. It's a moment to watch very closely because it could directly impact the Fed's next move and, in turn, the trajectory of your portfolio.
Beyond the big economic data, Thursday is also expected to be one of the busiest days of the Q2 earnings season, with nearly 700 companies reporting. What key reports should we be paying attention to, and what crucial insights might they reveal about the health of critical economic sectors?
These are not just isolated company reports. They're vital pulse checks for the broader economy that can either confirm or powerfully challenge the market's current optimism. First, for consumer health, we'll get reports from luxury handbag maker Tapestry, TPR, and footwear brand Birkenstock, BIRK.
Tapestry and Birkenstock. What are we looking for there?
These will provide crucial, real-time insights into the state of the consumer, especially higher-income demographics, and any observed impact from lingering inflation or, crucially, tariff-related uncertainty, which could tie back to our earlier discussion about the U.S.-India trade friction. Are consumers still willing to spend on discretionary items, or are they tightening their belts, like Kalia suggested, maybe?
Right, a reality check on consumer spending, particularly the higher end, contrasting with Cavier's warning, perhaps. What about the industrial and agricultural sectors, which are so foundational to the economy?
For that, we'll be keenly watching agricultural and construction machinery giant Deere & Co., DE. Its results and outlook will offer a valuable perspective on the health of the global agricultural economy, the pace of construction activity, and any financial impacts stemming from ongoing trade disputes or commodity price volatility, which are becoming a more prominent theme in global business. Their commentary often provides a window into the backbone of the economy.
Deere is a bellwether. Got it. And in the technology and semiconductor space, which has been such a major market driver this year.
In that critical technology and semiconductor space, Applied Materials, AMAT, a leading provider of chip-making equipment, will release its earnings after the bell.
Applied Materials, crucial for the chip supply chain.
Its commentary will be vital for assessing the strength of demand in the broader semiconductor industry, the ongoing impact of U.S. export restrictions on China, and critically, how it's capitalizing on the surging, almost insatiable AI-driven demand for advanced chips. Given the CoreWeave example we just discussed, investors will be very keen to see if this growth is coming with a healthy path to profitability or unsustainable cash burn. These reports are not just about individual companies, they're vital signs for the broader economy.
This has been a truly powerful, sentiment-driven ride for the market, largely propelled by the belief in an imminent Federal Reserve pivot, pushing major indices to record highs and significantly suppressing volatility. It felt like a wave of pure optimism.
This optimism, however, exists in a fragile state, juxtaposed against a series of significant and arguably underpriced risks. The market is very much in a risk-on mode, yet the underlying current of geopolitical tensions is anything but calm and in some cases actively escalating.
The road ahead, then, is contingent on several key variables, almost a series of stress tests for this market's current conviction.
Exactly. The immediate test is the PPI report tomorrow. An upside surprise on inflation, particularly in the core reading, could act as a potent catalyst for a market pullback, quickly dashing hopes of aggressive Fed cuts.
A quick sentiment shifter.
Potentially. Beyond that, the binary outcome of the U.S.-Russia summit looms large, with the potential for either a significant de-risking event if a genuine breakthrough occurs, or a sharp re-escalation of geopolitical tension if no meaningful progress is made.
But perhaps the most significant latent risk, the one that's truly a blind spot for many, is that escalating U.S.-India trade war.
That's it. This conflict has the potential to create the very inflationary supply chain disruption that the market is currently celebrating the absence of.
Yeah.
It represents a major blind spot in the current bullish consensus, a brewing economic storm that could directly undermine the disinflationary narrative.
Wow.
The combination of extremely low volatility, a market rally built on a specific interpretation of economic data, and the quiet presence of major known geopolitical and trade risks calls for a high degree of vigilance.
So, what does this all mean for you? The coming days will truly determine whether the market's foundation of hope is solid enough to withstand the incoming tests of data and diplomacy. What stands out to you as the most surprising or concerning element from today's deep dive, and how might you adjust your own perspective or your own vigilance based on these insights? We hope this deep dive has given you a clearer, more nuanced understanding of where the market stands today and where it might be headed tomorrow.